Welcome everyone, and let's talk about something incredibly important for every investor and every business owner out there. And this is saving thousands on taxes. How to save thousands on taxes. This is updated expert tax strategies for investors and business owners. Before we dive in, if advertisements should interrupt this video, please do not click off of the advertisements. Please allow them to play through as a thank you to me for bringing you this honest, valuable information for free. Now let's continue. You see, the difference between a good year and a great year often comes down to one thing: smart tax planning. We're not talking about aggressive, risky strategies, but expert, updated, and completely legal methods that successful people use every single day to dramatically reduce their tax bill. This is about making the tax code work for you, instead of just working for the government. The key, the ultimate secret, is being proactive. We're going to dive into the core tax strategies that can put thousands of dollars back into your pocket. Understanding the foundation. Tax planning for growth. The first step in our journey to significant tax savings involves mastering the difference between a deduction and a credit, and understanding how your business structure impacts your liability. Think about your business entity for a moment. Are you a sole proprietor, an LLC, or an S-Corporation? Choosing the right business structure is one of the most foundational and powerful tax strategies a business owner has. For many small business owners, especially those who transition from a sole proprietorship, restructuring as an S-Corp can be a game changer when it comes to self-employment tax. This is a complex area, but the basic idea is that a portion of your business income can be treated as a distribution rather than entirely as wages, potentially reducing your overall self-employment tax burden. We've seen countless examples where this single expert-level move instantly translates into 5 figures of annual savings. It's a crucial initial step in tax optimization that too many overlook. Now, let's turn our attention to the incredible power of tax deductions and tax credits. A deduction simply reduces your taxable income, but a credit is a dollar-for-dollar reduction of your actual tax bill. That's why understanding and maximizing every available tax credit is so vital. Are you hiring veterans or individuals from targeted groups? Look into the Work Opportunity Tax Credit. Are you investing in research and development for your business, even in a non-traditional industry? The R&D tax credit is not just for huge pharmaceutical companies anymore. Many small and mid-sized businesses qualify and miss out on a massive tax reduction. The power of timing. Income and expense management. The next pillar of successful expert tax strategies is mastering the art of timing. Specifically, managing when you recognize income and when you incur expenses. This is often called tax bracket management or year-end tax planning. If you know you are heading into a significantly higher tax bracket this year, perhaps due to a large capital gain or a major business deal, you want to shift things around. For example, if your business uses the cash method of accounting, you have a window of opportunity. You can defer income by simply delaying invoicing clients until January 1st. That payment and the corresponding income then falls into the next tax year, which can be invaluable for lowering your current year's taxable income. Conversely, you want to accelerate deductions. Do you need new office equipment, software subscriptions, or perhaps a significant vehicle purchase for your business? Making those purchases and paying the invoices before December 31st can allow you to claim the deduction this year, reducing the income that's subject to that high tax rate. This brings us to a fantastic, tangible piece of advice: maximizing depreciation. Specifically, leveraging Section 179 and bonus depreciation. Instead of writing off the cost of new equipment over many years, which is standard depreciation, Section 179 and bonus depreciation often allow you to deduct the full purchase price of qualifying business assets in the year you put them into service. Imagine buying a $50,000 piece of machinery. Instead of depreciating it by a few $1,000s, you can take a full $50,000 tax write-off right away. This is one of the most powerful, actionable tools in the business owner's arsenal for substantial tax savings. Investing for tax efficiency. Strategies for investors. Now, let's pivot to the investor side of the equation. Whether you are a full-time investor or a business owner building a separate portfolio, the goal is tax-efficient investing. The single biggest, most accessible strategy for every investor is maximizing tax-advantaged accounts. First, are you maxing out your retirement contributions? This includes your 401k, a SEP IRA, or a solo 401k if you are self-employed. Contributions to these accounts are typically tax-deductible, immediately reducing your current taxable income. This is essentially a guaranteed tax reduction every single year. Next, let's talk about the triple tax advantage powerhouse, the Health Savings Account, HSA. You contribute money pre-tax, the money grows tax-free, and you can withdraw it tax-free for qualified medical expenses. If you don't use it for health care, it acts just like an extra retirement account after age 65. If you are eligible for an HSA, maximizing this is non-negotiable for superior personal finance and tax planning. Beyond retirement, we have the advanced technique of tax loss harvesting. As an investor, you will inevitably have some stocks or funds that have lost value. Instead of holding on to them, you can sell those losing investments to offset any capital gains you realized from selling profitable investments. For example, if you sold stock for a $10,000 profit, you might sell a different fund for a $10,000 loss, resulting in zero net capital gains tax for the year. Even better, if your losses exceed your gains, you can deduct up to $3,000 of those net losses against your ordinary income, which can include your salary or business earnings. Any excess loss can even be carried forward into future years. This is a prime example of an expert tax strategy that requires year-round attention, not just a frantic push in December. And a quick note on where you hold your assets, a concept called asset location. Place your investments that generate high ordinary income, like bonds or actively managed mutual funds, inside your tax-deferred accounts, like a 401k or traditional IRA. Conversely, put tax-efficient assets, like low-turnover index funds or municipal bonds, in your regular, taxable brokerage account to take advantage of the lower long-term capital gains tax rates. Leveraging business deductions and credits. Let's circle back to the business owner, because this is where the biggest tax savings are often found. We need to look beyond the obvious expenses. Have you considered the home office deduction? If you use a portion of your home exclusively and regularly as your principal place of business, you can deduct a percentage of your mortgage interest, property taxes, utilities, and insurance. The rules are strict, so meticulous record keeping is required. But for the self-employed, this is a legitimate and valuable tax write-off. Another high-value strategy is maximizing your team benefits. Offering a retirement plan or a health insurance benefit to your employees is not just good for morale. It creates significant business tax deductions. Furthermore, the small business health care tax credit can help cover a significant percentage of the premiums you pay for employee coverage, again, reducing your tax bill dollar for dollar. And finally, consider strategic employment, hiring family members. If you hire your child to work for your business, paying them a reasonable wage for legitimate work, that wage is a deductible business expense for you. For the child, their earned income is subject to their own low tax bracket, and they can even contribute to a Roth IRA, creating a fantastic long-term, tax-free investment vehicle for them, while providing an immediate tax deduction for your business. It's a classic win-win tax planning scenario. Conclusion: making the shift to proactive tax planning. Ultimately, the biggest takeaway from all of these expert tax strategies is this: you cannot wait until April 15th or even January 1st to start thinking about your taxes. The ability to save thousands on taxes comes down to proactive tax planning that you implement throughout the year. The tax code is complex, but it contains legal, ethical pathways designed to incentivize certain behavior, like investing for the long term, creating jobs, and buying business equipment. Your job, as a savvy investor and business owner, is to understand those incentives and utilize every single one. From choosing the right business structure and maximizing your retirement contributions, to leveraging tax loss harvesting and the power of bonus depreciation. These tax optimization moves are how the wealthiest individuals and companies grow their fortune. It's time to stop simply reacting to your tax bill and start designing your tax outcome. Consult with a qualified tax professional who specializes in investors and business owners, not just a generic preparer, to ensure you are taking full advantage of every single one of these actionable strategies. Don't leave thousands of dollars on the table. If this content provided any value, subscribe so as not to miss our next value-packed video. Click the thumbs up button to give us a like for bringing you this vital free information. Comment below sharing a helpful tip on personal finance and investing. Disclaimer: the information in this video is for information purposes only. Seek advice from your financial investor.